Okay, so picture this. It's 2008. The financial world is in absolute chaos. To stop the bleeding, the U.S. Federal Reserve goes on an unprecedented shopping spree, buying up trillions of dollars in assets. But that unleashed this giant economic mystery. When the Fed writes a check that big, who exactly cashes it? Today, we're going to follow the money.
Right, so that's the big question here. I mean, when the Federal Reserve decides to buy trillions of dollars worth of stuff, it's not like they're just walking into a store. They're buying from other players in the market. And for a really long time, nobody had a clear picture of who those players actually were. And just to give you a sense of the scale we're talking about, in just one of its programs, the Fed bought $1.25 trillion in what are called mortgage-backed securities. Yeah, that's a 1 followed by 12 zeros. It's almost impossible to wrap your head around, and figuring out where all that money went is, well, it's pretty important. You know, for the longest time, this whole operation was basically an economic black box. Economists had their theories, sure, about how pumping all this cash into the system was supposed to work, but the actual plumbing of it all, the real-world journey that cash took, total mystery. So the main theory everyone was working with is called preferred habitat, and it's actually a pretty simple idea. Think of different investors as shoppers in a giant supermarket. Some people, they only buy the safe, reliable stuff, like government bonds. That's their aisle. Others prefer the riskier, high-growth stuff in a different aisle. The theory says these shoppers usually stick to their favorite aisles. So the Fed's big idea was to go in and buy up everything in the safe aisle, hoping it would nudge those shoppers to go explore some of the slightly riskier ones. And this is the data that had everyone scratching their heads. Each of these lines is a different type of investor. Before 2008, things are pretty stable, pretty predictable. And then, bam! After the crisis, the lines just go haywire. They cross, they diverge, it's just chaos. It was obvious a massive change was underway, but figuring out the how and the why was the real puzzle. Okay, so this is where the real detective work kicks in. A team of economists basically said, let's trace the transactions. They decided to dig through mountains of data to figure out once and for all who was actually on the other side of these trades with the Fed. And what they found was, well, pretty surprising. Let's look at Treasury bonds first. When the Fed was buying, who was selling? Get this, a whopping 60% of the sales came from a group labeled simply households. Not big banks, not other countries, households. And this wasn't just a fluke. They saw the exact same pattern with mortgage-backed securities. You know, those bundles of home loans that get packaged up and sold. Once again, the single biggest seller, by a long shot, was this households category. They accounted for almost half of all the sales to the Fed. So it didn't matter what the asset was. Government debt, mortgage stuff, the data trail always led back to the same place. This mysterious investor group called households. This was a huge breakthrough, but honestly, it just opened up an even bigger question. Okay, but hold on a second. What does that even mean? Are we really saying that my neighbor, your uncle, everyday folks, were the ones selling billions in bonds directly to the Federal Reserve? Something about that just doesn't feel right. So what exactly does the government count as a household? And this is the kicker. This is the big twist in the story. It turns out that because of how this financial data gets categorized, that household label is a giant catch-all. And guess who gets lumped into that same category? Hedge funds. That's right. The main group selling to the Fed wasn't just mom and pop. It was some of the most sophisticated, fastest-moving financial players on the entire planet. All right, so finding out it was actually hedge funds and these super savvy investors getting the cash, that changes the entire game. Because now the question isn't just who sold, it's what did they do with all that money? What happens when you hand $1 trillion to the world's most active investors? This is what kicks off something economists called the portfolio rebalancing channel. And it works kind of like this. Step 1, the Fed buys all those safe assets. Step 2, the hedge funds get flush with cash. And step 3, this is the crucial part. They don't just let that cash pile up in a bank account. No way. They immediately go out and buy other, slightly riskier things, like corporate bonds. And that new demand pushes up the prices of those other assets, which in turn pushes down interest rates for everyone else, making it cheaper for businesses to borrow money, expand, and hire. And this isn't just a theory. The researchers found the receipts, the hard evidence. You can literally see it here in the data. As this household group sold safe stuff like treasuries to the Fed, their holdings of riskier things like corporate bonds went up. The money didn't just disappear into a vault. It flowed from one type of asset into another. So, if you boil it all down, it's a pretty straightforward swap. The Fed comes in and pulls the super safe assets off the table. In response, these smart investors take their new cash and push it into the next tier of slightly riskier stuff. It's like a domino effect rippling through the market. So, okay, why does any of this matter? Why go through all this trouble to follow the money? Well, because it finally proves how these massive unconventional policies actually work in the real world. It shows that it isn't just wishful thinking. There's a real, predictable chain reaction happening under the surface. So let's just run through what we've learned, because it's pretty huge. First, the Fed's money didn't just sit on the sidelines. It was immediately put back into play by these sophisticated investors. This is the first concrete proof that the portfolio rebalancing channel is a real thing, not just a textbook theory. And that gives the people making these decisions a much, much clearer map of how their choices actually play out in the real economy. And look, this isn't just a history lesson, because what goes in must eventually come out, right? Knowing who the sellers were on the way in gives us a huge clue about how markets will react on the way out. When the Fed decides to reverse course and start selling all these assets, we now have a much better idea of who's going to be on the other side of that trade. And that, right there, is the next trillion-dollar question. We've figured out what happens when the biggest buyer in the world goes on a historic shopping spree. But what on earth happens to the economy when they decide it's finally time to sell?